Welcome back, everybody. George Moorhead, Bentley Properties, and our guest star today, Dan Golden.
Hello.
So we just went through a forbearance, what to expect if you're going to do a refinance, what to expect if you are going to do a purchase. So make sure you watch that video. But this time we're actually going to go through what mortgage trends are, what should you expect. We're heading into basically our fall, winter months here, and we're going to talk about some of the trends, some of the craziness that's going out there, including mortgage-backed securities, and how you should plan for it. Well, that's only if you're interested in saving money, right?
Right.
All right, fair enough. Okay, so let's get on with this. Dan,
Yes,
first,
George.
interest rates, as we know, a lot of people think, oh my gosh, the feds create the, when they say, oh, the feds aren't going to make any money, that is the mortgage interest rate,
Right.
which is false.
Right. That's false. That the Fed rate, when you talk about the Fed rate, that's usually your shorter term interest rates, home equity loans, car loans, credit cards. They say they're going to lower the interest rates. It does affect the mortgage-backed securities slightly and sometimes dramatically, but for the most part, that they say they lower a quarter or half, that's your credit card rates going down potentially. Right. It doesn't necessarily mean that the mortgage rates are going down. They do tend to follow slightly, but there's also adverse effects on occasion. Sometimes it goes the other way.
Right.
So I get a lot of calls from people going, "Hey, I heard the rates went down a half or a quarter." Like, no, they didn't. They, and then I have to explain it to them. But
yeah, my favorite call is, the folks saying, hey, it's time for me to buy a house because I can get zero interest because the feds aren't charging anything.
Right.
And I'm like, wait. That has nothing to do with it. That is.
Well, and by the way, to talk about that really quick, when they say the lending rate is zero, which it's about zero, don't forget the banks have to make money. So they charge a premium on top of that. That's
how they make their profit.
That's how they make their profit. They're not going to borrow money at zero and lend it to you at zero.
Yeah.
They're going to borrow it at zero and lend it to you higher so they can make money. So understand that piece.
Correct. So, and sometimes for folks that look at commercial, that's where you get the prime plus. If you look at some HELOCs, prime plus, right? And so that's really important. So a HELOC, home equity line of credit, for those it's just one and the same. HELOC happens to be an acronym. All right. So there are factors, since the mortgage interest rates are basically also part of a publicly traded, it's on the stock market, so they go up and down every day, right? Morning rates and afternoon rates can be totally different.
That's right.
So making sure that if you're getting a quote from Dan in the morning and then you get a different quote from somebody in the afternoon, that could be two entirely different price points.
That's right.
Okay.
So
all right.
when you're shopping, shop at the same time, as close as you can.
Because it changes.
Right.
Right on.
Right.
Okay. So does the economy affect rate?
Absolutely. And as probably all of you are seeing, there's a lot of volatility in the market, and that volatility translates to the mortgage-backed securities being somewhat volatile as well. So there's going to be fluctuations. 2 weeks ago, the rates were for 0 points under 3%. Now they're a little bit over 3%. That could reverse itself with more volatility. And some of the volatility what's causing some of this volatility is, the biggest one, in my opinion, is a supply chain issue, which is causing a lot of turmoil in the global markets and the U.S. economy. We can't get goods from the manufacturing, which is mainly in China, to the U.S. And that's causing problems with the economy, because if you can't get your materials, you can't build a house.
Right.
Construction worker can't work. So it's got a major ripple effect. I mean, that's just one example.
Sure. So to make sure that we piggyback on that, understand that the more volatile the market is, okay, so your big investors, the folks handling your 401ks and your Roth IRAs, all of these different investments that you have, including your retirement accounts, right? All right. When they see volatility, all right, and instead of risking your dollars, they'll go into bonds. Right. When the value of the bond goes up, interest rates come down.
Right.
Okay.
Right.
But then as the market improves, they get positive signs. They move out of bonds. They move back into the general market.
Right.
And we're talking trillions of dollars, people. We're not talking you and me, the the average day investor. We're talking trillions of dollars, billions of dollars moving. And then when they move out, then bond values come down. or 10-year Treasury, and then interest rates go up. So many times, well, all of the time, your supply chain, the concern about debt ceiling, the Biden multi-trillion-dollar craziness has an impact on that. The Feds are now saying that in November they're going to taper buying mortgage-backed securities. Other video, I have Marie post that. We'll go into that more in detail. That has a big impact because now the Feds aren't buying as much. That's going to affect the value of that bond.
Right.
Okay.
Which is supposed to make rates go up.
And
supposedly.
Supposedly, well, it has, because we were at 2.8, went to 2.9, then we went to 3.125. Now we're at 3.25. Right?
Yep.
Okay. So they've been hedging up, but your prediction, and not to throw you into the bus, we're going to look at a little prediction here.
Yep.
What do you expect over the 30, 60 days?
I expect them to stay pretty flat in that low 3 range. And by the way, when we're talking about these rates, I'm talking 0 points. So you will see advertisements out there for rates under 3. I have rates under 3. Typically, you're paying a point, a fee to buy down that rate, which is typically a percentage of the loan size. A $300,000 loan with a 1 point, 1% is a $3,000 upfront cost you pay to buy down the rate. And I can show you if that's worth doing or not. But when I'm speaking of what the rates are, I'm talking specifically no point rates. If you're seeing other rates out there, I can probably show you how that works. But so I wanted to clarify that. So I think rates are going to be no points at around the low 3s. Potentially go down a little bit on days, potentially go up. You're going to see volatility, like I said, so it's hard to really give you that prognostication. But I think over the next 6 to 12 months, if I move to that, they're going to be between 3 and 4. They are going to potentially go up in the high 3s within the next 12 months. So just be aware of that. That will decrease your buying power. And it will, make your payments higher potentially, or decrease your buying power. But we have a little solution for that.
So hang on. So I'm going to have Marie pose 5 questions you need to ask when getting quoted mortgage rates. I'm going to have her post that link. That is in participation with Dan. It walks you through. So he was walking through today. Hey, we're quoting you par pricing. Okay. Now you might look online and see something completely different. Watch that video. 5 questions you need to ask about rate, and to fully understand what to ask, what to look for before you say, oh my gosh, this is a great rate. Okay? Because there are restrictions and conditions to each and every one of them. And you need to know what they are and if you qualify. Okay? All right. So when we talk about another option that is new, it's on the forefront, it's changing, right? The SOFR, Secured Overnight Finance Rate. Dan, every once in a while you pop off with something I have freaking never heard of before. And you came up with this one. I thought maybe you were thinking when you're going to sit in the sofa, and that's not the case.
Oh man.
What is this?
Okay. I don't know where you come up with this stuff. You're probably going to start hearing more about this because anybody who has a loan that's tied to an ARM, not talking about HELOC, talking about first mortgages, typically your loan is tied to the LIBOR, which is an index, and I don't really want to get into what that is. It's the London overnight rate. And they are moving all those loans, even if you have one currently, into a different index, which is called the SOFR, Secured Overnight Finance Rate. And that's what you're going to start seeing. If you have an ARM currently, you're probably going to get some sort of notification that, hey, your loan is moving from LIBOR to the SOFR. But that also, you can apply for new loans on this ARM product, and they are tied to they're called a fixed period ARMs, okay? A fixed period ARM is a loan that is fixed for a certain number of years, and then it can adjust after that fixed period. Okay. And typically they are 5, 7, or 10, 5 years, 7 years, or 10 years. So if you have a 7-year ARM tied to the SOFR, your rate will be fixed for the entire first 7 years, and then it will adjust based on this index. That means if you're going to be in your house less than 7 years, you would benefit by doing this ARM because they're typically 0.5% to 0.75% lower than the typical 30-year fix. So,
but you should only do that if you're interested in saving money.
yes. And you think you're not going to be there more than 7 years or 5 years. So if you're going to be there long term, I don't know if this is a smart move. We can talk about that and the pros and cons of that. It could still be a good idea for you. But there's these ARM products out there now, the SOFR ARM, that could benefit you and could save you money.
Right. Now, here's the thing, and this is what's really important to understand. Some folks just like the security of getting a 30-year mortgage because of whatever. Here's the however, all right? Again, because interest rates are backed by the level of risk. When the lender knows that there's less risk, because if you're doing a 5, 7, or 10-year mortgage or a 10-year ARM, okay, that means that they know that you are going to be cashing out. There's less risk. Because there's less risk, they are giving you that benefit. In fact, they incentivize you by offering you lower rates, okay? And granted, those change every single day. So the benefit, if you were going to be in that less than, either 5 years, 7 years, or 10 years, okay, why not save that money? But again, depending on what your plans are, and that's the big picture, and that's what Dan is saying. He's going to help you out with that, talk about the pros and the cons,
right,
and what you want to do.
Right.
All right. So really, let's just recap. We know that everything is pretty volatile right now. Rates are bobbling along. Sure, they're a little bit higher. Still amazing. Still amazing rates.
Yeah.
Yeah. So with that, we're expecting, and we've been talking about it the last few weeks, that our mortgage rates are going to start hedging up, and we're predicting by the end of Q2, second quarter of next year, somewhere around 3.5%. And it's going to go up a little, it's going to come down, but we're going to see more of a upward trend than a downward trend. And I think Dan's right. I think by the time we hit the end, next year, this time, or a little bit more, we will be something that's going to be bumping up, if not crossing over that 4% mark.
Right.
So,
yep.
Again, in 2018, we ran into the same thing, but we were bumping over the 5% mark. And of course, that had a significant impact on people's buying. Their buying slowed down. As we broached into 2019, we're seeing the same type of activity. And then we started seeing rates start to come down mid-2019. Then, of course, you're supposed to stay home in 2020, which you didn't because you went out and bought a house. Record numbers of people buying homes. Rates went down even further. Inventory has crashed with it. And now we've got, basically 7 days of inventory. Rates are still amazingly low, even for non-owner occupied, because I think they're what?
3.75.
3.75 for any investor that has been in the market for 7, 8 years or longer knows that is just absolutely amazing.
Yeah,
absolutely amazing.
Yep.
So, and that's with no points.
Right.
That's incredible.
Yeah.
Anyway, so if you have questions, Maria's going to go ahead and post Dan's contact information. Reach out. There's no cost. There's no obligation. Feel free to hit him up. In fact, I would tie up his time all the time, if I would,
And I work 7 days a week, honestly. I'm pretty much available 7 days a week.
Okay.
My kids I'm an empty nester.
You are?
Yes.
Okay.
Just recently, so I have lots of time on my hands. So
I need a new nest.
Call me. A new nest?
Yeah, you're an empty nester. I need a new nest. No?
It's a different.
I'm up for adoption.
Talking about something else. Oh, no. No.
You guys have a great day. Hope you guys have some fun. Hope you learned something. Make sure you hit subscribe. Make sure that you get alerted when we're doing these updates. Hit the little bell. If you have questions, feel free to post them. We normally answer them within about 30 minutes. I guess Dan answers them sooner than I do. We answer them within 30 minutes, except for on Sunday. You need to give us a little more time. In the meantime, have an absolutely fabulous weekend. Hang around. We're going to do the real estate market update. You're going to learn a little bit more about what the heck is going on. And is our inventory plummeting again? Or is it on the rise? We're going to find out. I'll see you guys in the next video. Take care.